Big news coming from this year's annual Goldman Sachs Tech Conference. We spoke with top CEOs to bring you the latest and greatest from the tech world, from AI technology to all of our exclusive interviews. Here's a recap of the conference. Take a listen.
Welcome back to Yahoo Finance Live. We're still live at the Goldman Sachs Tech and Media Conference in San Francisco. And the other undercurrent at this conference is, in fact, all things happening in media. Lots of focus, of course, on AI, but that other undercurrent is media and what may be happening next. And to that end, Brett Feldman is here, Goldman Sachs Managing Director covering telecom, cable, and media. Thanks for having us to your conference, Brett. We appreciate it.
We're so excited to have you here. This is one of the biggest events we do all year. We're going to have the senior leaders and CEOs from over 200 global TMT companies. It really should be a great couple of days.
No, it's already shaping up to be that way. And a lot of the chatter in the room is the situation between Charter and Disney. And my question to you is why is this happening right now?
That's right. So just for your viewers who I think probably know by this point in time, if you're a Charter customer, so if you have Spectrum Cable, you can't get any Disney channels right now. They've been removed from the service, and that includes ESPN. So you made a great point. We've been seeing the number of households that pay for cable and satellite TV bundles decline for years. Why are we now just getting to this point where the distributors, the cable companies, are really pushing back? There's really two reasons why. The first is we're going to see the total number of households that pay for TV this year decline by about 6 to 7%. About 2 years ago, that was negative 5%. A couple years before that, it was a much more moderate number. So this has been an accelerating pace of decline. The reason why 6 to 7% is interesting is that historically the media companies like Disney, have been able to raise the price of their channels by about 5 to 6% per year. So we've hit this tipping point now where the media companies simply can't raise prices fast enough to offset the loss of pay TV subscribers. I think that has emboldened the cable companies to look at this relationship and say, listen, we can't absorb these historical price increases. We need to talk about a new model. That's one of the things that Charter talked about. Another point Charter made is a point we actually started making about 4 years ago, which is that they've reached what they call a point of economic indifference. Basically, they're saying we almost don't care anymore whether our customers decide to pay for a channel package or not, because they've lost so much profitability in that business as a result of cord cutting. They really make all their money now providing internet service. And so I think that you have the cable companies saying, we can't do this anymore. We were able to deal with it for a couple of years when we were losing a small number of customers. But as this snowball continues to roll down the hill, we have to come up with a new model.
At the end of the day, when this comes to an end, and it inevitably will, who is the biggest loser? And what does it mean to the broader media landscape?
It's a great question, and actually we're going to be asking a version of that question to all these CEOs of the big media and cable companies when they're here this week. And really the question we're going to be trying to get an answer to is, what's a win-win? If the model that we've had before, the relationship between the media companies, between the cable and satellite companies, and the relationship that they ultimately have with their viewers, if that's not working anymore, what is going to work? And are there other things that have to change? Maybe the way they price their streaming services in order to get something that works for everyone involved, including the consumer.
Do you agree? I think it was last week, Barry Diller at IAC said the streaming companies, they're not your friends. They're your enemies. Is the ultimate problem here companies like a Netflix?
I think Charter has been trying to make that point. Their view is that the media companies have devalued their entertainment by moving on to streaming platforms. And they give examples of it. They say, historically, you've been able to capture some of that value through advertising. You're barely doing any advertising on your streaming platforms. It's a new thing and you're not doing a lot of it. There's no security. It used to be that if you wanted to watch what was on cable TV, you had to pay for cable TV in your home. I think we all know that password sharing has become a big deal. Netflix has recently started cracking down on that, but not all the media companies have. And just in general, I think that the distributors, the cable and satellite companies, they look at what they're being asked to pay to make that content available to their customers, and they look at the price that those same media companies are charging to make it available on a direct basis. They say these are not the same prices. There's got to be a way that we come up with a sustainable economic model we can all agree on.
Is there any appetite to own these media stocks, and what has to happen?
Well, I think there is, in part because they've been under so much pressure. A stock that we have talked a lot about is Warner Brothers Discovery. David Zaslav, the CEO of Warner Brothers Discovery, will be here tomorrow. They are able to do something that some of the other media companies cannot, which is that they're still integrating a very large merger. They had acquired the Time Warner assets, the old Time Warner assets out of AT&T about 2 years ago, and they quickly realized there was a lot of inefficiency in how that business was run. And so they have an opportunity here to keep taking costs out of the business and hopefully make the products better at the same time so that they can generate cash, they can pay down debt, and ultimately do something that should be accretive to their shareholders by positioning the company to be a winner in the streaming wars. But to be fair, it's a highly debated sector. That's a highly debated stock.
Not lost on me, Brett, is last year Bob Chapek was here, now former CEO of Disney. Disney CEO Bob Iger is not here. Of course, there's always scheduling conflicts, et cetera, but to me, I think it says a lot that Disney's not at this premier conference, and it says a lot about the challenges they're going through. What has to happen to get investor appetite back into a stock that's about 52-week lows, despite the content power that is Disney?
Well, Disney's been here for a number of years, and so it would have been great if we could have made the scheduling work, but we'll hopefully have Bob Iger back. There's a few things they have to do. They have to demonstrate that they can continue to be on a path to profitability in streaming. So one of the nice inflections that we've seen since Bob Iger returned is that the losses they've been incurring in their streaming business have begun to compress very significantly. So proving that they can make money and then give some indication as to what those margins can be over time, I think that's really important. I think in their traditional media networks business, which really revolves around ESPN, they have to show that they can transition ESPN from being a package of cable and satellite TV channels to being something that you can subscribe to on a direct basis, meaning something you could stream. A lot of people may say, well, hold on, can't you get ESPN Plus right now? You get that in your bundle with Disney Plus. It's not the same thing. It's a niche product. They haven't put the full suite of sports rights that they have access to into that product. If they can do those two things, they will really be able to demonstrate that they have a strategy and a model for taking what is a very profitable, historically very profitable media business and turning it into a profitable streaming media business.
I mean, Bob made a lot of headlines a couple months ago suggesting everything was on the table. What's the end game here for him? Is it a spin-off of ESPN? Is it a sale of those linear TV assets?
I don't think we know. I thought what was refreshing about those comments, I think some people heard him as a little bit alarming, but I think that what was refreshing was to hear him acknowledge that everything is on the table. If you go back a few years when cord cutting wasn't quite as intense as it is right now, in some cases you would hear media companies talk about this being manageable, taking a very long time, not likely to get any worse. I think investors were always very skeptical of that. To hear a leader in the industry like Bob Iger acknowledge that you have to put everything on the table right now, I think shows how seriously they're taking this and is a real signal to the street that they're going to do what they need to do so that Disney can have another 100 years of success in the market.
Are investors waiting for that big move to get back into the stock? Do they want to see him pull the trigger on something mind-blowing?
I don't know if it's one thing. I think you have to look at this and say, as he's returned to the company, he has made the adjustments that are necessary to put the company on the path they need to be on. Because what investors really want is they want to see a company that can execute its way to success. And if you're still debating what they're supposed to do, that can be an overhang on the stock. So the main thing is setting a strategy and then setting a strategy that the market thinks will work if you execute it.
Along the lines of Disney at a 52-week low, I look at Paramount. You still rate the stock a sell, right? What has to happen to get investors excited about that name?
Paramount faces a lot of the same issues that Disney faces, a lot of the same issues that Warner Brothers Discovery faces. One of the things that they are very committed to is continuing to invest in their streaming platform. So whereas many of the other media companies have already moved past peak investment, meaning that they're getting closer to breaking even, not farther away, this year, Paramount will probably see their peak losses, meaning they're still leaning into the investment. To their credit, the service has been much more popular with viewers than I think a lot of people guessed. And they've had some real hits. They've put the NFL on the platform. So I think they feel very good about the subscriber momentum. What they have to be able to demonstrate to investors is that they can not only pivot away from being in an investment phase, but accelerate towards making money in their streaming business, because they, just like everyone else, are going to see their legacy networks come under increasing pressure.
Brett Feldman, Goldman Sachs Managing Director, covering telecom, cable, and media. Thank you for having us at your conference. This is one of our favorite ones by far.
Oh, thanks for being here.
Goldman Sachs analysts and top executives from across the technology, media, and telecom landscape are gathered in San Francisco for the company's annual Communicopia and Technology Conference. Yahoo Finance's executive editor Brian Sozzi spoke with Lyft CEO David Risher on what's driving the ride-sharing industry forward. While Lyft and Uber have been considered rivals for many years, Risher considers consumers' obsession with Netflix and, quote, staying at home eating pizza a much bigger threat to Lyft's success. Risher also breaks down the important lessons he learned from his former boss, Jeff Bezos, and why a business is only as strong as its leader.
I am a customer-obsessed person. I've worked at Amazon for many years. I drank all the Amazon Jeff Bezos Kool-Aid about how the best businesses are the ones that fundamentally meet customers' needs and just blow people away. And so for me, I think that the Uber-Lyft dynamic over the last couple of years has been more a competitive dynamic than a customer-focused dynamic. And so what got me really excited about joining up with Lyft is saying, let's really turn this into a customer-focused thing. Let's turn it into being obsessed by our riders, obsessed by our drivers, and you can see the results.
Is the battle about taking it back to Uber, or is it about taking it back internally, getting that vibe back that Lyft was always known for?
Well, I'd say it's about taking it to customers. I really think that. I mean, look, we are social beings. We want to get out of our house. But at the end of the day, we also spend a huge amount of time on our screens. So it's funny you think of it this way, but part of Lyft's reason for being is we're sort of the interface between your phone and the real world. So that's really what it's all about. And then the excitement internally of trying to build cool products and services for customers, for riders and drivers is fun.
When you're saying that you're focused on the consumer and you want to be consumer obsessed, what does that mean for the Lyft platform? What's not on there that you see could be on there next year?
Well, let me start with kind of the basics, right? Because when we started a couple of 4 months ago, our prices weren't quite in line with where the market needed them to be. So now we've reset our pricing to be competitive with where Uber is. Lower prices than we used to have, for sure. Same with driver pay. We've increased driver pay to be in line with where the market is, and that's really important. Drivers make billions of dollars on our platform, and we need to pay them well. So full stop. So that's where it starts. Then it's about picking you up on time and making sure you've got a good experience every time. And I hope every single day we do that, and I hope we're doing it better every day than we did the day before. And then you start to get into the more differentiated pieces. So let me give you an example. Everyone likes a good deal sometimes, right? We all feel like at some point we want a deal. And so we have an option called Wait and Save, which allows you to basically say, I'm willing to wait another 5 or 10 minutes and I'll get a cheaper price. And something like 30% of our riders every single day take us up on that option. So the reason I point that out is because I think it's a really good option for people who want to save a couple bucks. By the way, I think it's better than Uber's shared ride or pooled ride option. Be a little bit competitive on that one. And I think it's an example of how if you really focus on what customers want, you can start to build back to work products or maybe back to school products or all sorts of other things that'll really meet the customers where they are.
Are you priced below Uber? What does your data show?
So our strategy is to make price shopping kind of a waste of time, if I can say it that way.
Does it bother you when Uber has these earnings calls and they say they're not thinking about Lyft? Should they be thinking about Lyft?
No, I don't want them thinking about Lyft. I want them thinking about their own problems. They got all sorts of stuff. Their CEO recently said, I wake up every morning thinking how much Uber sucks, and I'm like, that's cool. We agree on that. So anyway, I'm just kidding you. Look, my real focus is I want to focus on our customers. And sometimes what I say is, I don't think our big competition is Uber. I think our competition is staying at home, watching Netflix and eating pizza. I mean, as much as fun as that is, I guarantee it's more fun to go out with a friend.
When I talk to John Zimmer, I've talked to him many times through the years. He pitched this vision to us about Lyft being everything to everybody, shipping this, doing that. Is that your vision?
No. And I think this is an area where John and I 100% agree. In fact, I know it is. But I think in retrospect, he might say that a little bit differently. And here's what I mean. The best companies are the ones, as we've said before, that really focus in and say, what can we do for our customers that really is differentiated? And it's hard to differentiate on everything. It really is. And so our focus is on rideshare, providing a great experience every single day. For a time, I think particularly as COVID came, there was a real feeling of like, oh my God, the rideshare business, is going away because of COVID or whatever it is, and so let's try a bunch of other things. But we're coming out of COVID and we're saying, guess what? People still want to go to work, they still want to go to school, they still want to get together with their friends and all the rest, so we're really going to focus on that way.
Your tenure started off, you may have to make some tough decisions, notably on staff, to lay off a good portion of the staff. Are you confident you have gotten to the cost structure that you want to get to?
Yes. Yes. So I appreciate you saying it was hard. It was really hard. Nobody likes it. Of course, employees least of all. Let's be very clear. We had to do it. And the reason we had to do it is because in order to offer good prices, you have to have a cost structure that makes sense. And to your earlier question, if your goal for a while is to sort of try to do everything, you tend to grow your costs. Whereas if your goal is to try to do one thing really well, you have to shrink your costs. So we shrank our costs. That did mean we had to lay off some employees, but we're at a state now where we can innovate on behalf of customers, we can keep the business moving forward, growing financially healthily, and not have to do anything crazy with the costs.
And for those not really familiar with your plan, is the bikes business still part of Lyft? Do you want it to be part of Lyft?
Yeah, so I'm glad you asked about bikes. Let me just, kind of level set for a second. Just in New York City, so Lyft runs bike systems across the United States in a bunch of cities, in Chicago, in New York, in DC, San Francisco, all across the United States. And if you've been on one of those bikes recently, particularly in an e-bike, I hope your experience has been great. I mean, once people start e-bikes, they tend to really fall in love with them. It's a great way to get across the city. In New York alone, we give about 130,000 rides a day. A day. That's as many as in LA, that's as many subway rides as LA does in a day. So I mean, it's a big part of a transportation network now. So for our riders, it's super important. It gets them from point A to point B, often faster than a car, frankly, if it's in New York City. But it's also a capital intensive business for us. And so we're trying to figure out a way to partner with other organizations that specialize in city infrastructure in a way that allows them to take some of the cost of capital, from us effectively, and allow us to just offer it to our riders without it being such an expense for us.
Within the data you are able to receive, what's the health of consumers? Do you see consumers still spending at the clip they were? Are they taking the same amount of rides? What do your users look like?
Yeah, it's so interesting. I know there's a little data out there about some retail softness or and concern about student loans and so forth. We're not seeing any of that. On the driver's side, we see really healthy supply, and on the rider side, summer travel was as strong as it's ever been, stronger actually. Back to work is already feeling like it's off to a really strong start, and same with back to school. So we're not really seeing any softness.
Lastly, before we let you go, not a lot of folks can say they were the 37th employee of Amazon. I mean, that's some OG stuff. What did you learn from those early days, and how are you applying it to Lyft?
The single biggest thing really was that focus on the customer. And it's a bit of a cliche now, in part because Jeff Bezos has sort of made it a cliche. Frankly, I'm trying to take it up to the next level at Lyft. One of the things that I would like 3 years from now, 5 years from now, is that Lyft has redefined what it's like to be a customer-obsessed organization. And one of the things I tell our employees sometimes is, if we're ever so unlucky that you go off and get another job, I hope that other company is just thrilled to get you because they know how customer-obsessed you're going to be. That's really what I learned from Jeff and from Amazon.
Well, top executives from across the tech, media, and telecoms landscape are gathered in San Francisco for the Goldman Sachs annual Communacopia and Technology Conference. At the top of the attendees' agenda, the role of AI in the workplace and how companies can win across the evolving tech ecosystem. Yahoo Finance's executive editor Brian Sozzi has been speaking with leaders in the space about the emerging technology's potential. We've got one of those conversations right now.
All right, joining me now is Okta co-founder and CEO Todd Mckinnon. Todd, where are we just here doing this?
Another year, another Goldman Sachs conference.
Yes,
it's great to be here.
Well, thanks for joining
Yahoo
us.
Finance.
I appreciate you always coming on with us. Now, I read a note recently about Okta, and it said, Okta is due credit for improved execution. Do you think Okta is getting enough credit for all the turnaround work you've been doing since we last saw you at the Goldman Conference?
Well, we've been working hard, and I think what people are looking at is you're seeing a company that is able to grow revenue 23% in the quarter we just reported, and also generate a significant amount of cash. We generated almost $50 million of cash. And so this balance of growth and improving profitability is pretty attractive, especially when you consider the really big markets we're going after. So we've improved, we want to continuously improve, and we're excited about the trajectory we're on.
At a conference like this, what are some of the questions you're getting?
So they want to know about the big picture, but they also want to know about the proof points to get there. I think one of the biggest difference in the last 2 years is that, of course, investors are always worried about the big secular trends, the companies that could be big, the markets that could be big, but they want more proof points about how you're actually getting there. what progress have you made in the short term and the immediate term. Before you can talk about that forest, they have to see a few more trees, which I think is a healthy thing for all of us.
The enterprise business for Okta, what's the health and status of that business?
Well, when you think about the whole macroeconomic situation, one thing we've observed in our business is that smaller companies, if you're a company with just a couple hundred employees or 50 employees, you're being pretty cautious with your spend overall and specifically your technology spend. Larger enterprises, they've kind of locked in their budgets at the first of the year and they're executing now. And you saw that with our quarter we just reported. Our top 25 deals in the quarter were $100 million of total contract value, which is incredibly healthy. The cohort of $1 million plus ACV deals was one of the fastest growing in the history of Okta. So I think you're seeing a big strategic priority for identity, and you're seeing some stability in the budgets of larger organization, which is driving the results we delivered.
And that's one of the call-outs from your most recent quarter was the ability to win bigger deals, maybe bigger deals than you had been winning in prior quarters. What do these companies want from a company like Okta at this point in their lifespan?
Well, they want a few things. The first thing they want is they want to improve their customer experience. You know, people are talking about cost and efficiency, but at the end of the day, businesses want to grow revenue, they want to cut costs, and they want to eliminate risk. And we can help them do all of that. We can help their customer retention. We can make a better experience on their mobile app or their website. We can help them convert users from anonymous to logged in users. We can help them do that more effectively and efficiently, and they could do that by writing their own code. In fact, one of our customers is OpenAI. We're the login for ChatGPT. So the developers at OpenAI didn't build login. They focused on AI, and I think that was the right decision for them, and their success would say the same thing.
OpenAI is grown like a juggernaut. How is that growth translating to growth for your company?
Well, it's an important growing customer for us, and we're focused on making them successful like all our customers. But I think the most exciting thing I am about it is two things. One is that I think there's going to be 1,000 new technology companies with great apps and services delivered around AI, and those are all going to need identity. The next Salesforce automation or the next finance management or all these categories are going to be revolutionized by the AI technology, whether that's in some categories like CRM, maybe it's CRM that does it. But in a lot of categories, this is going to be new companies, new technology, all that need identity. And then when you take them in a workforce setting, the enterprises that are absorbing all this technology are going to need a great workforce identity solution to secure it, manage it, and make sense of it all. And we can help them with all of those.
Is the hype around AI real? Does it deserve to be as hyped as we're making it out to be?
So here's the thing. I'm a pretty even-keeled guy.
Yes,
I don't get too excited about things. There's a lot of hype in our industry. I think this may be underhyped. I think it impacts things at so many levels. It impacts how we, what we drive, what we don't drive, what drives itself. It impacts how we interact with computers and how they seem personal. It generates how art and media is created. It's really a breakthrough in computer science, and it impacts not only the products, but it impacts how software is created. AI tools can help us make better software, whether it's development copilots or software that can, in some cases, write itself or improve itself. And that's pretty profound at different levels of the tech stack. So I think the industry is really has a powerful macro driver for a long time.
Do you view Okta as an AI play? Do you even think about it like that?
I think it's almost like a trick question because everything's an AI play. When every company needs a technology strategy and all of technology is being impacted by AI, every company by extension is an AI company. So I think it's a little bit, you have to say yes to that. Now it's the specifics around how you benefit. Well, I think we can benefit from multiple ways. One is we can provide picks and shovels to the miners. We can make sure that people building AI technology and trying to make it secure and trying to get it delivered to enterprises and consumers can have a great identity infrastructure to do that. And we can make sure that we can use AI in our own products, whether it's detecting threats or building better recommendation on how to use and set up Okta. We'll be talking a lot more about this at our conference coming up October 3rd here in San Francisco, Octane. So make sure you come see us for that.
Anything you can tease?
Well, it's like not surprisingly, if I say AI is underhyped, we're going to try to hype it more, right? So you can see us there. And then the last thing is that we have to make sure as we run our company, both from the products, but also how our business processes and the technology we use, we have to make sure that this AI the potential is put to good work inside of our company as well. So yeah, I'm very excited about it. As the industry in a warranted way should be.
I was talking to a CFO of another tech company at the conference, and they were talking about how it's hard to find talent to support these AI initiatives. Do you find it hard to find the talent you need to implement all these AI initiatives?
Well, I think it's always hard to find great talent. I think that, anyone that's been in technology or been in a growth company or try to do more with technology knows that talent is really important, and it's always a challenge. I think the thing about AI is there are researchers and experts, and that's a very, very rare skill and very prized possession. But I think a lot of the industry is learning together. They're learning about the potential of these things. They're learning about how they can put into products. And I think with a smart, engaged workforce that's motivated to deliver on what Okta's trying to do, we're in a good position to bring on new people that have this expertise, but also to take all of our entire teams and learn about AI together with the whole industry to take us to the next level.
Okta co-founder and CEO Todd Mckinnon, always great to get some time with you. Let's do this again next year.
I'll be here. See you then. Appreciate it.
Let's dive into all things tech with a little consumer angle with Max Levchin, co-founder and CEO of Affirm. Didn't we just do this last year?
We did.
We did.
Seems like 2 weeks ago.
I know, it really was. So big news out of your company today with Booking, and it seems like you're making a deeper push into the travel space. Why is that the case?
It's one of the few segments that just keeps growing very, very well. There's just unbelievable demand for people to get out of town and shake off the pandemic.
Isn't this one way using Affirm to maybe just go out there and take a vacation if you don't have to upfront, thousands of dollars?
Exactly. That's a canonical Affirm use case. We're very good with things like t-shirts and shoes and smaller items, but if you're looking at that first big trip overseas and you haven't gotten out of town or country in a while, you kind of want to make sure it's great, and paying for it upfront can be quite expensive, and Affirm will help you get into one of those things without fees, typically without even too much interest.
How big a business is travel related as it pertains to Affirm?
It's a major segment for us. I don't think we disclose exactly just how big it is for us, but we definitely disclosed that at least a quarter ago, it was growing triple digits, which is quite impressive. Most recent quarter, it was still growing on that same sort of zip code. And so people are, even as the US economy, broadly speaking, is cooling, we can tell, travel is going very strong.
You have a phenomenal read on the health of consumers in this country, specifically middle income to lower income consumers. Yeah. What's your read on them right now?
Ask me again in 60 days and I'll really tell you.
I will. I'm going to send you an email.
You should. Reason being, the student loan accruals just restarted a couple of days ago, and then the first bills are going to start coming in. We think it's not actually going to be a major thing for the US economy. We know it's not going to be a major thing for us, but obviously we're very cautious. Credit is always job number one. That said, US consumer has been unbelievably resilient. I think at this point, even Federal Reserve governors have come out and said, we're not quite sure why the standard rules don't exactly apply. And maybe it's the pandemic, maybe it's the fact that people just have to get out of town, but US consumer has been pretty good about paying their bills on time and shopping and doing their best to push the economy forward.
As this increasing financial stress comes onto the consumer, how are they at paying their Affirm bill?
They are doing a great job, as a matter of fact. We just reported our quarterly earnings a couple of weeks ago, and we once again posted a sequential decline in delinquencies. So the measure of our financial performance relative to the consumer repayment is how good are they about being on time, and they're really good. They're better last quarter than they were the quarter before.
You think that's sustainable if now these consumers have to pay back their student debt?
So for us, because we underwrite every transaction and because the typical term of a transaction is so short, it is not an output so much as an input. I think in the world of credit card issuance, when you're giving people lines a couple of years ago and they spend, and then suddenly times get tough and you got to pay your bills, that's when they start building up delinquencies. And you see that in the industry a couple of quarters ago, it started really accelerating. Ours did not. It is because every financial decision that we make, one, we keep credit in mind as job number one, but two, we ask, at this point, the models ask the question, can this person actually pay us back? And if the answer is we don't think so, we will decline them. And we have a lot of tools to say yes. For example, we can say, hey, you can be approved for a $600 travel ticket, but you can make a down payment and we'll finance 400 of it. So there's lots of ways to yes, but ultimately we do not issue loans when we don't think consumers can pay us back. And as a result, we have a lot better control over our delinquencies.
On the consumer front now, it is not the Affirm, Debit Plus card? Is it Affirm
It's the Affirm card.
Affirm card. Any stats you can share on that?
So we flashed a whole bunch of really cool stats. If you look at our quarterly earnings supplement, you'll see what looks dangerously like a hockey stick curve of the active card growth. We announced that we hit 300,000 active cards last quarter, and it's growing really, really well, very rapidly. It is a very cool product, so in my opinion, not a surprise to that people are latching onto it and having a great time with it. We are still in a super early innings. Obviously, our user base is in the millions, tens of millions. Affirm Card is sub 1 million as of last quarter, but the growth is pretty extraordinary.
When do you open up that spigot? All these people are on your platform already. Why can't you just give them all cards?
In my experience, and I've had a few in financial services, you frequently regret opening up a unstoppable funnel of a new credit product. So we're going to be deliberate. We have opened it up. So the hockey stick very much documents our decision to say, we think this really works. It resonates, it's got a great product market fit, people love it. We get lots of very clear messages from consumers saying, this really clicked for me, I love it, it's better than my debit card. Debit Plus name meant that your debit card can't quite do all the things that ours can. Affirm Card is maybe a better name, but it really is a debit card with unique features. You can swipe and just pay for things right now, or pay for things over time on the same card, your decision in the app. So as we saw product market fit, as we saw the financial results that we wanted to see from the economics of the card, we've made it, generally speaking, open, but we have not yet told our consumers, you gotta get one. So it's available. If you're eligible, it'll just magically appear in your app as a thing you can say, hey, send me one of those things. I think at some point in the future, we'll definitely say you gotta have one of these things, and it will be available to the Affirm user base. We don't expect to market it, there'll be no CAC, but we got lots of people to offer it to.
Max, you're, I think I've told you this before, and if I haven't, I'll just say now, you're an OG in tech. I mean, it is, and it's always
I think I'm an O.
Okay, fair, but it's always special to get a few moments for you, and this is a special moment in tech with AI, and I've had two executives over 3 days tell me they are concerned about AI, artificial intelligence, what it might do to society. Do you share those concerns, and what are we up against the next decade?
So I think, like anything else, it is up to us to decide and act on what it can and cannot do. I think when humans invented first weapons, when humans invented the loom, when they invented machines, steam power, go back as any technological revolutions you can count, there were always people saying, oh my God, it's upon us, it's gonna take all the jobs, it might do terrible things to society. Generally speaking, it caused temporary and sometimes fairly long-term havoc where people were losing jobs and people had to be retrained, et cetera. And so all of that is very possible. And there will be people whose jobs will be made obsolete because AI will be better and cheaper. And so I think it's nothing to dismiss and not to laugh at. But I don't think we live in the world where it is a passive reality that the AI train is coming and we're not strapped to the rail. Like, it is an incredible collection of discoveries, inventions. It is a wonderful tool to make us more productive. Sam Altman, I think, says that it's like every one of us will have 1,000 personal assistants doing 1,000 things concurrently. That alone is a mind-boggling awesomeness that we should not dismiss or shy away or discount. And so I'm very bullish on AI. I think it's a collection of wonderful opportunities. I think probably more to the point, where does it accrete? It will initially at least really help companies with massive distribution and massive data to just amplify their offerings to create new value-added, lower cost opportunities for their products to evolve. I think maybe a bigger question is, if you're a startup, what do you do with all this AI bonanza out there? And if you look at the Y Combinator most recent class, I think 60% is building something in AI, so people are trying and making it up. But generally speaking, I'm very positive. I don't think we are so foolish as to allow the AI to turn us all into paper clips by saying, let's see what happens.
I still don't want to turn to paper clips. I remember you telling me that before. I don't want that. I have 15 seconds left. I know you're creating a firm. You work very hard. I always see you just busting your butt off. Do you want to play in AI in your next decade? I mean, not a firm. Do you see yourself creating another business? Do you want to be in that moment in a different way?
Affirm is a very long-term project for me. I am quite committed to it, and I love what I'm doing. That said, we have a ton of really cool AI stuff that we're doing within Affirm. 15 seconds is not nearly enough to explain it, but and we're pretty good at not saying too much before we launch something cool, but watch the space. We have AI ideas of our own.
All right, keep us posted. All right, Max Levchin, co-founder and CEO of Affirm. Always great to see you. At the Goldman Sachs Tech Conference here in San Francisco, right out of the gate, went Nextdoor CEO Sarah Friar. Good to finally meet you in person, Sarah. It's been, 10 interviews, and I've never met you before.
It's great to see you in real life.
Actually, yes. So this conference very focused on AI and in this AI moment. How should investors be thinking about this AI moment, given you've spent many years in tech? What does it mean to them, and what do you think it will mean?
Yeah, I mean, I think we're all talking about it, but it's also because it's happening. It's not a new thing. ChatGPT unleashed generative AI and really brought it in, I think, to the cultural domain. But of course, we've all been investing in data for now decades, and we're starting to see it come to fruition. Nextdoor is no exception, doing some pretty cool things on the AI front with our assistant and also with Vitality. Be happy to share more.
How will this AI moment impact a business like Nextdoor?
Yeah, so for us, it actually starts to unleash unique data. We are the local knowledge graph, so I think the value of what we do starts to really shine forth. We're the only platform where you're finding out what's going on around you locally in real time. So with that data, we can do things like on the platform, help a neighbor compose a post in a way that is more engaging. So the assistant or the AI actually does that for you. When we're thinking about areas like moderation, we often stop you in your tracks and say, hey neighbor, would you like to rewrite that? Now we even offer you a suggestion of how to rewrite it in a way that's more constructive. So those are just two ways we're using AI ourselves, but it also starts to unleash what local data could mean broadly for models throughout the world.
It sounds like the Nextdoor platform is going to be fundamentally changed by AI. Is that fair?
That is fair to say, yes. Anyone who has big, unique data, where data is naturally tagged, I think they start to become a really interesting, unique asset.
I'm not lost, of course, we're at this Goldman Sachs conference, a lot of investors here, analysts, bankers, you name it, but is this year an investment year for Nextdoor? Given everything you're doing on AI, do you have to tell this room, maybe we don't see the margins we want, but we might see them 2 years from now?
Yeah, I think what we've told the street is we've been public now for almost 2 years, not quite. And we said, hey, we're going to raise money in the capital markets because we are a platform that has tremendous opportunity. Everyone in the world is a neighbor, but we need to go invest to look more like folks that we would consider competitors. That's on two sides. One is to continue to grow the platform. So we've over 80 million neighbors today, super engaged. And then the other side is to build our own proprietary ad tech stack. So we have been in investment mode. That said, in Q2, we showed both revenue growth and margin improvement. So we want to make sure that as we grow, we are giving investors back that margin leverage so that ultimately we can become a really high-performing, profitable company.
What's your outlook on the user growth front? We've seen a lot of people go back to the office, maybe not engage with a lot of social media platforms, but how do you see it at Nextdoor?
Yeah, so we see growth in multiple ways. One is WOW, is how we have talked about it externally. Our WOW grew about 13% year over year in Q2. But importantly, as people come to the platform, they're going deeper into the platform. And that's a signal to us that we're giving them more value. It might be in a cost of living crisis, ways to make money, find money in your neighborhood or in your home. It might be in a disaster, how to save yourself, save your neighbors, help your community. And so if they go deeper, that drives sessions to grow faster, frankly, than WOW. And if sessions grow faster, impressions go faster, and revenue grows faster. So we can see growth in multiple parts of the funnel at Nextdoor.
So you're gaining new data in new ways. This has to be now an easier sell to advertisers. You've really been focused for the past few years on getting more advertisers on your platform. What is your outlook for the next 12 months there?
Yeah, that's right. So for sure, the ad market has had its own issues over the last 12 months, as you know, as we've gone through corporates really pulling back in areas of variable spend. That said, in Q2, we got back to revenue growth. For Nextdoor, what we really sell on is, number one, we are real people at real addresses. That location data is really unique and differentiated. So for advertisers who have, say, an online to offline presence, like an Albertsons or a Walgreens, that's really important. Second, we're a very high intent audience. You come to get things done on Nextdoor. That's usually great for advertisers, including the smallest of businesses in your community. And then finally, we have that online to offline piece. So anyone that wants to do offline calls to action, stores, for example, we work really well for them. And that's done well in terms of new logos that we've added.
What's the biggest question you get from investors, and what do you think is coming at you at an event like this?
I think where you started, number one, is what can Nextdoor do with all the data that you have? How can you use the uniqueness of your platform? I think the second piece is they want to understand when will we be on that proprietary ad tech stack, because then we can use our data even as we drive revenue. And then third and finally, they of course want to understand when we can be a profitable business, and we're driving towards that. We're still small, relatively speaking, but we're very well capitalized, great team in place, and so we're excited to see where we can grow from here.
Profit soon?
Not yet talking about it externally, but absolutely we intend to show margin progression as we go through 2023.
We were talking off camera, a lot of weird events been popping up, increasing storm activity, not just in the US, really around the world. Does Nextdoor have a role in here in helping people navigate these situations?
Yeah, first of all, it's incredible the shifts we're seeing. There have been $18 billion disasters in the US alone in the last 12 months, 18. And that's caused about $175 billion worth of damage. So clearly something is changing. If you're on the West Coast, we're worried about fires. If you're on the East Coast, there's hurricanes right now. Middle of the country, tornadoes. That's where Nextdoor can really help because, of course, in an emergency, it's really neighbors who save neighbors. It's not emergency services. They usually get overloaded. So what we've done is for National Preparedness Month, September, we just launched our Crisis Hub. It's a great place to go to get information. And of course, the singular most important thing you can do is invite your neighbor onto Nextdoor as a way to be able to communicate with them in an emergency moment.
A lot of households too, another emergency moment would be the cost of living.
Yeah.
We talk a lot about it being a deflationary environment out there. Finally, it's really not for a lot of households. What are you seeing on the platform? Are neighbors trying to help other neighbors and saving a few bucks, or even a company like Walmart, which you sit on the board?
Yeah, absolutely. So yes, cost of living has been very top of mind for neighbors. There's usually three ways on Nextdoor that they can help themselves or help their community. Number one is to find a job or find a side hustle. So we've seen a lot of that in the summer actually with students home from university or as they go back onto college campuses, also still looking for that part-time job, but that's true for anyone. Second way is on our for sale and free part of our platform. It's our marketplace. Today we see over $1 billion a month put on Nextdoor, but about 20% of everything in that area is offered for free. So if you want to find something like a table and chairs, someone in my neighborhood was looking for that last night, Nextdoor is perfect for that. And then the final area where people tend to come to make money is also just small businesses. They're often getting going in local communities. Nextdoor might be the first place they go to market. They can do it for free by claiming their business page. But again, that local economic growth is really important, all the way up to, as you point out, the Walmarts of the world as well.
Before we let you go, we initially started talking to right when the COVID-19 pandemic started. Looking back, how are you a different leader today than when that started?
Oh, wow. There was certainly no playbook. Like no one handed me the here's what to do in a pandemic. I think we have shifted, I read a lot that article over and over about peacetime CEOs and wartime CEOs. And I think the last 12 months, or maybe even the last 24, kind of coming through COVID and at the other side, has felt a little bit more like wartime, frankly. So number one is being more directive while trying to still stay very empathetic to your employee base, to your investor base, to your customer base. I think the second thing is being incredibly transparent about why you're doing something. To me, I've always been a leader that's tried to lead by saying, I'm going to tell you it all, warts and all, and that's how I'm going to kind of win, not just your mind with the numbers and data, but also your heart. And then I think finally it's looking for purpose. Great purpose-driven companies, I think, can really endure no matter what comes at them. And I think Nextdoor is that, the purpose of cultivating a kinder world where everyone has a neighborhood to rely on. I can't think of anything better that I want to get up in the morning and go after.
Well said, and good to finally meet you in person. I know it's
wonderful.
A very busy event. We'll let you go. Nextdoor CEO Sarah Friar, thanks for stopping by Yahoo Finance. We appreciate it.
Thanks so much.
Another key player that we follow very closely at Yahoo Finance as it pertains to the economy, small businesses, and AI, that's Intuit. And joining me now is Intuit CEO Sasan Goodarzi. Sasan, always great to get some time with you. Miss you here at this Goldman Sachs conference, but I know you have a lot of big AI initiatives and AI news hitting the tape here from your company today. Take us through exactly what you are announcing. My interpretation of it was you're layering in new forms of AI across your various platforms, TurboTax, Credit Karma, MailChimp, you name it.
Well, Brian, first of all, great to see you. I missed you at Goldman Sachs, but I know our CFO was there. So listen, yesterday was an enormous day for Intuit. At our Intuit Innovation Day, we launched Intuit Assist. And Intuit Assist is really a personalized, intelligent assistant in your pocket. It's also powered by AI-driven human experts so that when you are getting assistance from Intuit Assist, if you ever need to talk to an expert, no matter what it is that you're doing, you're able to do that. So there's always a gateway to help. That was the big news yesterday. If I were to double click a few examples of what we launched, for small businesses, now you have the ability to be able to grow your business, and we work with you to develop a marketing campaign. For instance, if you just came out with a new product, let's just say it's some modern furniture, we work with you to help you create an entire campaign. What kind of images, what kind of content, who do you want to target? You are always in control of being able to adjust the campaign itself, but we develop it all for you. And then once you confirm the campaign, we execute it for you and then help you with what the results are, what your cash flow is from that campaign, and what the next steps are, almost like you're sitting across the table from your marketing team. And really the intent is, based on all the data that we have access to, all of the investments we've made over the years, the last decade in AI, we're able to tip the odds in the favor of those that need it most. So it was a really exciting day yesterday, and we can't wait to launch all of these capabilities over time to our customers.
Out of all the very large businesses that you operated Intuit Sasan, which business will AI play the biggest role moving forward?
Brian, it's all of them, because if you just sort of step back and think about the problem spaces that we focus on, consumers are trying to make ends meet. They're trying to get out of debt. They're trying to save money. They're trying to, make more of the money that they have. And small businesses, their biggest focus areas are, how do I grow my customers? How do I retain them? How do I grow revenues? And how do I manage, my cash flow? So across our platform, Credit Karma, TurboTax, and across our small business platform, which is MailChimp and QuickBooks, this notion of delivering personalized, intelligent experiences is really important. So I'll just use another example for you, which is Credit Karma and TurboTax. Ultimately, we're trying to help you make ends meet. And so if you are in a situation where you have a big unexpected cost, your car breaks down and you have to have a large expense, we detect that on the platform. We will send you a notification that says, we can see that you've had a big expense. You have a cash flow issue. Here are several ways in which we would suggest that you can address your cash flow issue. We can give you early access to your wages. You can take out a personal loan at the lowest rate that's already been pre-approved for you to ultimately get you back up and running. And that's, think about the power of having an assistant in your pocket that is by your side every step of the way as a consumer or a small business to help power your prosperity. So really all of our investments over the years in data and AI, it's why it's been core to our declaration 5+ years ago, has really been to create a future where it's done for you. You're always in control, but it's done for you. And it applies to every part of our platform across consumers and small businesses, which I think is what makes this era of data and AI, and particularly Gen AI, so exciting, because I think it will ignite global innovation and create new economies.
Sasan, we see in the market action right now, lots of continued fear about rising interest rates and what it means to consumers, households, not just today, but of course in 2024. Your company offers a real great snapshot into some of those trends via Credit Karma and some other businesses, but notably Credit Karma. How strained are small businesses and that Gen Z consumer right now?
Yeah, well, first of all, for your viewers, we have over 100 million customers across our platform, across all of our platforms. So there is a lot that we see. I'll start with small businesses. Small businesses across the platform, their cash reserves are about 90% of what they were this time last year. Now, although it's down, it's actually significantly better and more improved than it was prior to the pandemic. So although they are being impacted by the current environment, they are actually in better shape than they were several years ago. On the consumer side, we see a couple of things. One, since March of last year, credit scores are down 13 points. Generally, credit card balances are up over 30%. And particularly with Gen Z, since you asked about them, their credit card balances are up over 45%. But many consumers have jobs. And so although they are being impacted by the current environment, they have jobs, but they're being strained in terms of being very intentional about where they're spending the money. And those are some of the stats that I think demonstrates jobs at the same time strained by the current environment.
Mental note to everyone watching this, cash is still king. Use cash. Don't have to put in your credit card sometimes. We'll leave it there. Intuit CEO Sasan Goodarzi, good luck with the AI journey. We'll talk to you soon. We appreciate you coming on, like always.
Thanks for having me, Brian. Take care.